Here's a question that keeps new investors up at night. Should you buy individual stocks or just put everything in index funds? What if I told you that 90% of professional fund managers can't beat a simple index fund over 10 years? Today, we're settling the great debate, index funds versus individual stocks. And by the end, you'll know exactly which path fits your investing style. Let's start with the basics. An index fund is like buying a tiny piece of hundreds or thousands of companies all at once. When you buy one share of an index fund, you're instantly diversified across entire markets. Individual stocks are the opposite. You're betting on specific companies. Instead of owning a piece of everything, you're putting your money behind particular businesses you believe will grow. Think of it this way. Index funds are like ordering the sampler platter at a restaurant. You get a taste of everything. Individual stocks are like ordering the steak. You're betting big on one specific choice. The key difference: diversification versus concentration. Index funds spread your risk across hundreds of companies. Individual stocks concentrate your risk in the companies you choose. Both approaches can build wealth, but they require completely different mindsets and time commitments. Index funds are the ultimate set-it-and-forget-it investment. Pros: instant diversification, minimal fees, no research required, and they automatically rebalance. You literally cannot pick a bad stock because you own them all. Cons: you'll never beat the market because you are the market. When great companies surge 50%, you only get the average return. You're guaranteed to be perfectly average. Individual stocks offer unlimited upside potential. Pros: you can beat the market significantly if you pick winners. You learn about businesses and become a better investor. You have complete control over your choices. Cons: you can also lose significantly if you pick wrong. It requires constant research, monitoring, and emotional discipline. Most individual investors underperform because they buy high and sell low. Here's the hard truth. Individual stock picking is a skill that takes years to develop. Index investing is a strategy you can start today. The question isn't which is better, it's which matches your personality, time commitment, and goals. Most successful investors use a combination approach. Here's how to choose your mix based on your situation. New investors should start with 80% index funds and 20% individual stocks. This gives you diversification while letting you learn stock picking with money you can afford to lose. Experienced investors might go 60% index funds and 40% individual stocks. You maintain your safety net while taking bigger swings at companies you understand deeply. Serious traders who love research and have time for analysis might flip to 40% index funds and 60% individual stocks. But remember, this requires treating investing like a part-time job. Ask yourself, do you want to spend hours researching companies, or do you want to invest automatically and focus on other things? Both answers are perfectly valid. The smartest approach? Start with index funds for your foundation, then add individual stocks as you learn and grow more confident. Index funds versus individual stocks isn't about right or wrong. It's about matching your strategy to your lifestyle. Start with diversification, add concentration as you learn, and never put all your eggs in one basket. Ready to build a professional trading approach? Visit verifiedinvesting.com for expert strategies and tools empowering smarter investors.